The biggest features of the week from a top-down perspective will be the annual meetings of the World Bank and the International Monetary Fund. They will run from the 12th to the 18th of October and will take place on a virtual remote basis this year, rather than in Washington DC as normal. You can watch keynote addresses online, and key topics under discussion include forging a resilient and sustainable economic recovery, tackling corruption, and also climate change. The IMF will also release its always interesting World Economic Outlook document, which it publishes twice a year and contains latest forecasts for growth, inflation, budget deficits, and many other things besides. The IMF's thoughts should be particularly illuminating. It's the IMF that often steps in with a bailout when a country gets into trouble with its borrowing and spending. But the latest edition of its semi-annual fiscal monitor argues that advanced economies should not worry about debt and instead use record low interest rates to invest in digital and renewable energy infrastructure to both boost growth and safeguard the future. This is a big change of tone, but one that follows cries for more active fiscal policy from US Federal Reserve Chair Jay Powell and European Central Bank President Christine Lagarde. Now, you could see this as an admission from central banks that over a decade's worth of quantitative easing and zero interest rate policies have failed and it's time for something else. You could see it as a precursor to more government spending and economic recovery and perhaps higher inflation. You could see it as further debasement of paper money. You could just see it as plain common sense. Which view you prefer, I shall leave to you. But two asset classes do seem to be paying attention, at least for now, to the clarion call for more spending and their gold and cryptocurrencies. The latter, I admit to my surprise, don't seem to be going away in a hurry. On the corporate front, there's a lot more news scheduled in America, where the third quarter reporting season will kick into overdrive from Tuesday the 13th of October onwards. Megabanks JP Morgan Chase and Citigroup will get things started, alongside Johnson & Johnson, with Bank of America, Wells Fargo and Alcoa joining in on the 14th. Back on this side of the Atlantic, half a dozen FTSE 100 firms are scheduled to update shareholders on current trading, with a smattering of mid to small caps expected to do the same. Names which may be worthy of note include the following: house builder Barratt Developments, JustEatTakeaway.com and recruitment specialist Page Group on Wednesday the 14th of October. Packaging player Mondi, miner Rio Tinto, retailer Dunelm and another recruiter, Hayes, on the 15th. Before commodities giant Everaz rounds off the week with an analysts meeting, alongside trading updates from fund managers Jupiter and Man Group on Friday the 15th of October. But for me, the stock most capable of causing a fuss in the week ahead is online fast fashion retailer ASOS. The company, the largest on London market's junior AIM platform, is due to report full-year results for the 12-month period that ended in August on Wednesday the 14th. ASOS shares have doubled in the past year and more, and now trade at a 12-month high. Investors may not be that shocked to see the shares do so well, given the company's strength is online retail and how online continues to gobble up share from bricks and mortar, either because of price, convenience, products, or something less voluntary like lockdown. After a wobbly start, when UK volumes fell by 20 to 25% in the first 3 weeks of spring's nationwide lockdown, ASOS has recaptured its momentum. It raised £247 million from shareholders in April to ensure it could come through even the gloomiest economic scenario, and in August noted trading had actually been much stronger than expected. As a result, ASOS's current guidance is for sales to be up by 17 to 19% year on year, which implies a figure of around £3.2 billion, and pre-tax profit somewhere between 130 and 150 million, which compares to 33 million a year ago, when ASOS actually dished out profit warnings due to substantial investments in IT, operational issues at its warehouses in America and the UK, poor stock availability, and aggressive discounting by rivals. So those are the first two numbers that analysts and shareholders will look for. They'll also turn to Chief Executive Officer Nick Baton for any guidance for the fiscal year to August 2021. Just in case he feels that confident, the current analyst consensus forecasts are 17% sales growth to around £3.8 billion and a pre-tax profit of £136 million. Above and beyond the headlines, analysts will then dig down for three following items: more detail on active customer numbers, site visits and sell-through conversion. A year ago, ASOS had 20.3 million active customers, and that figure had risen to 23 million by the end of June, according to a trading statement. Meanwhile, 2.3 billion site visits turned into 72.3 million orders for a 3.2% conversion rate. The retail gross margin fell to 47.4% last year, a drop of 2.5 percentage points, and slipped again to 45.4% in the first half. The company has focused on costs and capital investment and will have benefited from lower returns during lockdown like its rival Boohoo, so those trends may have helped to stop the rot. Finally, analysts and shareholders will look to the balance sheet. ASOS had £164 million of net debt at the end of its first half, but it's since raised that cash, cut costs, cut investment, or certainly held it in, and seen trading come in better than expected, so that should boost cash flow as well. Investors will also look for comments on sourcing, as China is a big supplier and it went into and then came out of lockdown early, while Europe's another big supplier and the issue of Brexit and possible tariffs still lurks here. Updates on the European and US hub warehouses will also be welcomed. All of the charts, by the way, only go back to 2012, as that's when the company shifted its financial year to the end in August. Now, I hope that you and your families are still all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you all again next week.